Welcome to this complete masterclass and explainer on IAS 2, all about inventories. Whether you're an accounting professional, an audit trainee, or a finance student gearing up for exams, you are absolutely in the right place. Think about it. Inventory is the undisputed heavyweight champion of current assets for manufacturing, trading, retail, and fast-moving consumer goods businesses. Getting your inventory valuation wrong? Well, it doesn't just skew a single number. It creates this massive domino effect that impacts your reported profit, your tax liabilities, balance sheet strength, current ratio, and your working capital. Honestly, it can even lead to a qualified audit opinion. So the fundamental goal of IAS 2 is to ensure that inventory is never, ever overstated on your financial statements. In this explainer, we're going to break down this standard completely. We'll look at the objective, the scope, initial recognition, cost calculations, net realizable value, the accounting entries, and the disclosures required. Here is our exact life cycle agenda for today. First, an introduction to IAS 2, followed by scope and inventory definition. Then we'll cover calculating true inventory cost, cost formulas, cost versus net realizable value, and finally, accounting entries, disclosures, and exam traps. By following this structure, you're going to master the objective, calculation, valuation, and final reporting of inventory. And most importantly, you won't fall for those common exam traps. We'll start with the core principles, move into exactly what makes up inventory cost, explore how to calculate it, and finally, how to report it correctly. Let's not waste any time. Let's just dive right in. Section 1, Introduction to IAS 2. Before we start calculating anything, we have to establish the absolute philosophical anchor of this accounting standard. This quote right here, this is the golden mantra of IAS 2. I really want you to burn this into your memory. Inventory is measured at the lower of cost and net realizable value, or NRV for short. This rule is deeply, deeply rooted in the conservative accounting principle of prudence. Basically, it dictates that an asset should never be carried on your books at an amount higher than what you actually expect to recover from selling or using it. If your inventory cost is simply not recoverable, maybe the goods are damaged, obsolete, or market prices just totally crashed, it has to be written down immediately. For example, let's say you manufactured goods at a cost of $100,000, but because of some major market shift, you can now only sell them for $85,000 after paying your selling costs. Well, that inventory cannot remain at $100,000 on your balance sheet. No way. It must be aggressively reduced to $85,000, and you take that $15,000 hit to your profit and loss immediately. Section 2. Scope and inventory definition. So what exactly qualifies as inventory, and what is explicitly excluded from the scope of IAS 2? Let's clearly define the boundaries of the standard. What is inventory? Well, it includes assets held for sale in the ordinary course of business, like your finished goods. It also includes work in progress that's actively in the production phase. And of course, it includes raw materials and supplies waiting to be consumed in production. But remember, inventory isn't just physical boxes sitting in a warehouse. If a property developer holds land for resale, that is absolutely considered inventory under IAS 2. But if they held that same land to build their own office on it, that would be property, plant, and equipment. On the flip side, we have strict exclusions. Shares, bonds, and derivatives, those are financial instruments, so they're handled by IFRS 9. Standing crops or livestock before harvest, those are biological assets under IAS 41. Now, interestingly, once that crop is actually harvested, boom, it enters the realm of IAS 2. There's also one very special measurement exclusion you need to know about. Commodity broker traders who hold items like copper or gold for short-term resale, they actually measure their inventory at fair value less cost to sell, following their industry practice, rather than the standard IAS 2 cost model. Section 3. Calculating true inventory cost. Moving along the product life cycle, once we actually know we have inventory, we need to calculate its exact initial cost without making any critical errors. Let's talk about the costs of conversion. When you're transforming raw materials into finished goods, your cost is obviously a lot more than just the materials themselves. You have to include direct labor and a systematic allocation of your production overheads. Now, here is where it gets tricky. How do you allocate fixed production overheads? We're talking about things like factory rent or machinery depreciation, costs that don't change based on how many units you actually produce. IAS 2 is incredibly strict here. You must allocate fixed overheads based on normal capacity, not abnormally low actual production. Think about it. If your factory normally produces 10,000 units, but a worker strike causes you to only produce 8,000, you can't just dump the entire factory rent onto those 8,000 units. That would artificially inflate your inventory value, making it look worth more than it is. Instead, you allocate based on the normal 10,000 units, and the unabsorbed overhead, that is immediately written off as an expense. Conversely, if you have an abnormally high production month, you actually decrease the overhead allocated per unit, ensuring you never value the inventory above actual cost. It's super important to understand the strict distinction between what gets capitalized into your asset and what gets expensed right away. Normal production wastage, like the expected scrap you get from cutting fabric or stamping metal, that gets absorbed into the cost of your good units. But abnormal wastage, say machine malfunctions and completely ruin an entire batch of raw material, that must be immediately expensed to the profit and loss statement so it doesn't inflate your asset value. Storage costs are another massive trap people fall for. General warehousing for your finished goods is just a period expense. But if storage is a necessary, integral part of the production process itself, like the multi-year aging of a fine whiskey or the curing of cheese, then that specific storage cost is capitalized into the inventory. And just remember, selling costs, outward freight to ship to customers, and general administrative overheads, they never ever belong in inventory cost. Let's also consider purchasing terms. If you buy inventory on deferred credit terms, meaning you negotiate to pay the supplier way beyond normal credit periods, that arrangement almost certainly contains a financing element. Imagine you buy goods with a cash price of $1 million, but you agree to pay $1.1 million in 12 months. That $100,000 difference? That is a finance cost. Under IAS 2, you record the inventory at the $1 million cash price, and you recognize the $100,000 as an interest expense over the year. You never bury financing costs inside inventory cost, unless, of course, you're dealing with a qualifying asset that takes a substantial period of time to get ready for sale, like our aging whiskey example, where IAS 23 borrowing costs might actually permit capitalization. Section 4. Cost formulas. Let's see how all this works when we have thousands of interchangeable goods sitting in our warehouse. Now, if you're selling unique, customized items like luxury yachts or custom-built machinery, you track the exact cost of each specific item using what's called specific identification. But what about millions of ordinary interchangeable boxes? For those, IAS 2 permits exactly two cost formulas: FIFO and weighted average cost. FIFO, which stands for first in, first out, basically mirrors the physical flow of most businesses. It assumes the oldest stock is sold first, which logically leaves your closing inventory valued at the most recent current purchase prices. Weighted average cost, on the other hand, blends the cost of your opening inventory and any new purchases to create a smoothed-out average rate per unit. You do have to make a policy choice here, but listen closely. IAS 2 dictates you must use the same formula for all inventories that have a similar nature and use to the entity. You can't use FIFO for your warehouse in one city and weighted average for the exact same goods in another city just to creatively manipulate your margins. I need to make this unequivocally clear because it's honestly one of the most heavily tested concepts globally. LIFO is completely, strictly prohibited under IAS 2. LIFO assumes your most recently purchased goods are the first ones sold. So why is this such a big problem? Well, in an environment of rising prices, it leaves your oldest, cheapest costs just sitting there on your balance sheet as closing inventory. This results in inventory values that are drastically outdated and absolutely do not represent current economic reality. Using LIFO is a massive exam trap and a severe audit failure under international financial reporting standards. So just erase it from your IAS 2 toolkit entirely. Section 5. Cost versus Net Realisable Value. At year-end, we hit the reality check. This is where we compare our painstakingly calculated cost against what the market is actually willing to pay us. Calculating NRV requires a bit of looking into the future. You start with your estimated selling price in the ordinary course of business. From that price, you must subtract the estimated costs required to complete the item, say if it's currently a work in progress, and then subtract the estimated costs necessary to actually make the sale happen, like sales commissions or final transport. The absolutely crucial point here is that NRV is highly entity-specific. It's based entirely on what your specific business expects to realize from these exact goods. This makes it completely different from fair value under IFRS 13, which is a much more generalized market-based measurement. NRV is your specific reality. You really have to do this comparison strictly on an item-by-item basis, rather than just looking at the total value of your whole warehouse. Why? Well, imagine you have item A, which has gained value, and item B, which is totally obsolete and lost value. If you just compare the total cost of your inventory against the total NRV, the unrealized gains on item A would secretly mask the real actual losses on item B. IAS 2 outright forbids this. You evaluate item A independently and carry it at cost. You evaluate item B independently, recognize its NRV has fallen lower than its cost, and write it down immediately. You cannot offset losses against unrealized gains unless very strict grouping rules apply, and that's only for items produced and marketed in the exact same geographical area that simply cannot be evaluated separately. Now, here is a brilliant nuance in IAS 2, and it's a scenario that catches so many professionals off guard. Let's say you hold raw steel, and suddenly global steel prices plummet. The replacement cost of your raw material is now way below what you originally paid for it. Do you immediately write it down? Actually, not necessarily. IAS 2 says you must look at the finished good that the steel will eventually become. If the final finished product will still be sold at a profit, meaning at or above its total cost, you do not touch the raw material value. You leave it at cost. You only recognize a loss on raw materials if the decline in material prices indicates that the final finished goods themselves will be sold at a loss. But what happens if business conditions actually improve? Say you wrote down inventory last year because of a market slump, but now prices have surged right back up. Well, IAS 2 requires a fresh NRV assessment in each subsequent period. If there is clear evidence that the NRV has increased, you are allowed to reverse that earlier write-down. However, there's a catch. The absolute ceiling for this reversal is your original cost. You are merely erasing the previous penalty. You are never, ever allowed to write inventory up to a value higher than what you initially paid for it. This rule perfectly maintains the standard's core mandate: never overstate the asset. Section 6. Accounting Entries, Disclosures, and Exam Traps. It is finally time for reporting. Following the physical life cycle of the inventory into the journal entries makes all this theory very concrete. On day 1, when you purchase or produce, you capitalize the cost, debit inventory, and credit your bank or payables. At year end, if your NRV testing reveals a shortfall, you immediately recognize the loss. Debit inventory write-down expense in your P&L, and credit your inventory asset to physically reduce its balance. Finally, the ultimate destination for inventory is the income statement. In the period you sell the goods and actually recognize the revenue, you match the expense. You debit cost of goods sold and credit inventory, clearing the asset from your balance sheet entirely. Oh, and as a quick aside, if inventory is used to build your own fixed asset, like say using your own manufactured bricks to build a new factory, that inventory is transferred to property, plant, and equipment, and expensed slowly over time through depreciation. Transparency is absolutely key to IFRS. In the notes to the financial statements, you must disclose exactly how you arrived at your numbers. This means explicitly disclosing your accounting policies and stating whether you used FIFO or weighted average. You must break down the total carrying amount into classifications appropriate for your specific business, showing exactly how much is raw material, how much is work in progress, and how much is finished goods. You have to clearly state the amount recognized as an expense during the year, explicitly detail any write-downs or reversals, and, this is crucial for lenders and investors, you must disclose if any inventory has been pledged as security for your liabilities. If you memorize this checklist of common pitfalls, I promise you will navigate any audit, practical scenario, or tricky exam question flawlessly. Let's recap the biggest traps really rapidly. First, never capitalize selling costs or abnormal wastage. Those are always immediate expenses. Second, always allocate your fixed factory overheads based on normal capacity, not actual low production runs. Third, ensure your NRV comparison is done on a granular, item-by-item basis. Fourth, remember that LIFO is strictly prohibited. And finally, don't write down raw materials just because market prices fell, unless the finished goods they create are also expected to generate a loss. I want to leave you with a provocative thought to really test your understanding. What if you hold 1,000 units of inventory, but you have a firm locked-in sales contract for 700 of them at a price much higher than the open market? How do you calculate your NRV then? Well, the secret lies in separating your obligations. You have to treat the protected 700 units differently than the 300 that are left exposed to the harsh market reality. Think about how IAS 2 demands absolute precision for every single unit. Thank you so much for joining me for this explainer on IAS 2. Keep these principles in mind, stay prudent, and you will never go wrong with your inventory valuation.